A few years ago, companies moved fast, almost too fast. In 2023 and 2024, businesses across industries made bold decisions, cutting costs aggressively, restructuring teams, pulling back on expansion, and in many cases, completely redefining their strategies. It was a reaction to uncertainty, rising costs, and a changing global economy. But now, something interesting is happening. Many of those same companies are quietly reversing course, not with big announcements, not with dramatic headlines. But step by step, decision by decision, the strategies that once defined survival are being adjusted, softened, or in some cases completely undone. And if you look closely, this shift reveals something deeper about where business is heading next. To understand why companies are reversing their 2023 to 2024 strategies, you have to go back to the mindset that shaped those decisions. During that period, the dominant theme was caution. Inflation was high, interest rates were rising, and demand was unpredictable. Businesses were preparing for the worst, so they cut costs, they reduced hiring, they paused expansion plans, they focused heavily on efficiency and profitability. Growth, which had been the main priority for years, suddenly took a back seat. The message was clear: survive first, expand later. But here's the problem. Strategies built for uncertainty don't always work when conditions stabilize. As we moved into 2025 and now 2026, the economic environment didn't collapse the way many companies feared. In fact, in several sectors, demand held up better than expected. Consumers kept spending, just more selectively. Certain industries even started growing again. And that's where the cracks began to show. Companies that had pulled back too hard started to feel it. They were leaner, yes, but also slower. They had fewer resources, less flexibility, and in some cases, they were missing opportunities. Competitors who stayed more aggressive began to gain ground. So quietly, companies started adjusting. Hiring freezes turned into selective hiring. Budget cuts became targeted investments. Expansion plans that were paused indefinitely started coming back, just under different names or smaller scopes. One of the biggest areas where this reversal is happening is talent. In 2023 and 2024, layoffs and hiring slowdowns were widespread. Companies wanted to reduce costs and protect margins. But now, many are realizing that cutting too deep created new problems. Critical teams became understaffed, innovation slowed down, projects were delayed, and when the market began to stabilize, companies found themselves unprepared to move quickly. So now, instead of broad hiring, businesses are focusing on strategic roles. They're bringing back key talent, investing in specialized skills, and rebuilding teams, but in a more controlled way. It's not a return to aggressive hiring, it's a correction. Another major reversal is happening in growth strategy. During the peak of uncertainty, many companies shifted to a do more with less approach. They focused on efficiency, optimization, and protecting profits. That mindset worked in the short term, but over time it started to limit growth potential. Now businesses are realizing that efficiency alone isn't enough. You can't cut your way to long-term success. At some point, you need to invest again, so companies are reintroducing growth initiatives, but carefully. Instead of chasing rapid expansion, they're focusing on sustainable growth. Instead of entering multiple markets at once, they're choosing fewer, higher confidence opportunities. It's growth, but with discipline. Pricing strategy is also evolving. In 2023 and 2024, many companies raised prices aggressively to offset rising costs. And for a while, it worked. Customers accepted higher prices because the entire market was adjusting. But now some businesses are noticing resistance, not loud resistance, but subtle changes in behavior. Customers are becoming more selective, more value-focused, and less tolerant of constant increases. So instead of continuing to push prices higher, companies are starting to rebalance. Some are holding prices steady, others are adding more value, better service, improved features, or bundled offerings to justify what they're charging. It's a shift from how much can we charge to how do we make this feel worth it. Another quiet reversal is happening in supply chains and operations. In the earlier period, many companies moved toward localization and redundancy. They wanted to reduce risk by bringing production closer to home and diversifying suppliers. While that improved resilience, it also increased costs. Now businesses are reevaluating that balance. They're not abandoning resilience, but they're optimizing it. Some are reintroducing global sourcing where it makes sense. Others are streamlining operations to reduce inefficiencies that came from overcorrecting. It's not a full reversal, it's a refinement. Technology investment is another area where strategies are shifting. During uncertain times, companies became cautious about large long-term tech investments. Projects were delayed, budgets were cut, and spending was scrutinized. But now there's growing pressure to invest again, especially in areas like automation, data, and infrastructure. Falling behind in these areas is becoming a bigger risk than overspending, so companies are returning to tech investment, but with clearer goals and tighter controls. They're not spending blindly, they're prioritizing what directly improves performance. And then there's perhaps the most important shift of all: mindset. In 2023 and 2024, the dominant mindset was defensive: protect margins, reduce risk, stay flexible. But in 2026, that mindset is evolving into something more balanced. Companies are no longer preparing for the worst-case scenario. They're preparing for a more complex reality where uncertainty still exists, but opportunities are also emerging. That's why these reversals are happening quietly. Businesses don't want to signal instability or inconsistency. Instead, they're making gradual adjustments behind the scenes. They're not saying, "We were wrong." They're saying, "We're adapting." And that distinction matters, because what we're seeing is not a failure of strategy, it's the natural evolution of it. The decisions made in 2023 and 2024 were based on the information available at the time. They were necessary. But as conditions change, strategies have to change too. The companies that recognize this early and adjust quickly are the ones that tend to stay ahead. So when you hear that companies are quietly reversing their 2023 to 2024 strategies, it's not a sign of weakness. It's a sign that the business environment is shifting again, and those who are paying attention are already moving with it. Because in today's economy, standing still is often riskier than changing direction.